Missiles in the sky, markets in the dark, right now. As described in the source material, the United States and Israel are launching missiles at Iran. Military targets are being struck. Israel has declared a state of emergency. US embassies across the Middle East are on lockdown. This is unfolding in real time. But here's what makes this moment different. Traditional financial markets are closed. It's the weekend. Comex is shut. London is shut. Futures exchanges won't reopen for another 34 hours. Yet one market never sleeps. Blockchain-based, tokenized gold. And according to the data in this document, it just printed 54.94, or $5,494 per ounce. That is $250 above Friday's close. Pause on that. A $250 move while major exchanges are dark, while institutional desks can't react, while headlines are still forming. That's not routine volatility. That's stress surfacing where it can. And here's why that matters to you. When price discovery shifts away from traditional venues and into 24/7 digital markets, it signals urgency. It means capital is looking for safety even when the old gates are closed. It means fear doesn't wait for the opening bell. Let's reset the focus. Iran is not just another geopolitical headline. It sits next to the Strait of Hormuz, a corridor tied to 20% of the world's oil supply. When conflict touches that region, energy markets feel it. And when energy markets feel it, inflation calculations change instantly. This isn't about abstract politics. It's about supply chains, fuel costs, and purchasing power. Now layer on the timing. The International Atomic Energy Agency reportedly indicated reduced visibility over 60% of Iran's enriched uranium reserves, based on what the TXT describes, that uncertainty alters strategic decisions. And strategic decisions alter risk premiums across global assets. Gold doesn't move because of drama. It moves because of uncertainty about currency stability, inflation, and systemic risk. Another quick reset. Markets hate unpredictability more than they hate bad news. If this remains limited, volatility may cool. If it escalates, capital will reposition aggressively. And right now, the only visible real-time signal is gold at 54.94, while legacy systems wait for Monday. That's the setup. In the next section, we're going to break down why the silver market, specifically in China, may be flashing an even louder signal than gold. The $120 silver signal no one can ignore. If gold at 54.94 made you pause, what's happening in silver should make you sit up straight. According to the source material, the physical silver buyback price in Shenzhen, inside China's largest precious metals trading district, jumped almost $20 in a single day. Dealers are now paying above $120 per ounce. Read that again. $120. The last international spot close was around $93. That's a $27 premium, nearly 30% above the global paper price based on the data provided. And here's the part that changes everything. This is not the retail asking price. This is what dealers are paying you if you walk in and hand over silver. They're buying at $120. And many small distributors, according to the TXT, are refusing to sell at all. Let's reset the lens. These are business operators. Their income depends on turnover. When the people whose job is to sell metal decide to hold inventory instead, that's not speculation, that's expectation. They are betting the metal in their vaults will be worth more tomorrow than the cash they would receive today. That's a signal. Now zoom out. The number you see on your trading screen is derived from futures contracts. Most settle in cash. The $120 figure in Shenzhen represents a physical transaction, real metal changing hands. When physical and paper prices diverge by nearly 30%, you are no longer looking at one market. You are looking at two realities. One says silver is $93. One says silver is $120. Both cannot be correct long-term. Another quick reset. You cannot manufacture solar panels, electronics, or industrial components with a futures contract. Physical supply matters. And when physical buyers begin paying aggressive premiums during an active geopolitical crisis, that tells you something about perceived scarcity. This didn't appear overnight. The document outlines prior warning signs. Shanghai premiums running 14% above international spot. Comex vaults reportedly draining month after month. China reclassifying silver as a strategic material and restricting exports to 44 companies. Mexico, the world's largest silver producer, facing disruptions in mining regions described as being in active civil conflict. Each of those factors was already tightening the system. Then missiles started flying. Here's why this matters to you directly. If physical premiums stay elevated, paper prices must eventually respond, either through repricing higher or through supply compression. Markets can ignore tension for a while. They cannot ignore sustained physical demand. And we're still 34 hours away from traditional exchanges reopening. That gap in time is building pressure. In the next section, we're going to talk about Monday morning and why the reopening could trigger one of the most violent repricings modern metals markets have seen. The 34-hour pressure cooker. Here's the part most people are underestimating. Markets are closed for another 34 hours, according to the source material. That means hedge funds, institutions, central banks, and retail investors are watching missiles hit targets, and they cannot act. That silence isn't calm, it's compression. Everyone went home Friday with gold around 52.50. Now tokenized markets are printing 54.94 or 5,194s. That's a $250 shift before traditional desks can place a single order. Imagine sitting at a trading desk, watching that unfold and knowing you're exposed. Let's reset the frame. When major geopolitical shocks happen while markets are closed, the reopening doesn't drift, it gaps. The price doesn't slowly climb from Friday's close, it opens somewhere entirely different. You go to sleep at one number. You wake up to another. The document suggests a potential $100 to $200 gap higher for gold at the open and $5 to $10 for silver based on current tokenized pricing. If escalation continues before Monday, those figures could expand. And here's why that matters. A gap higher doesn't just reward holders, it punishes shorts. Anyone who bet against gold at 5,200 or silver near 90 suddenly finds themselves deeply underwater. When that happens, brokers issue margin calls, and margin calls force buying. Forced buying pushes prices higher. Higher prices trigger more margin calls. That cascade is how markets move vertically. Quick reset. Silver is especially vulnerable to this dynamic because its market is smaller. It takes less capital to move it. In a stressed environment, small markets don't walk higher. They jump. Now layer in energy risk. Iran sits beside the Strait of Hormuz, the passage tied to 20% of the world's oil supply. If retaliation threatens that corridor, even without a full blockade, insurance costs surge. Shipping costs spike. Oil can move toward $150 or $200 a barrel in escalation scenarios described in the TXT that feeds directly into inflation. Producer Price Index data had already come in at 3.6%, with 6% core just days before these strikes. Inflation was already accelerating. Add an oil shock, and central banks face a trap. They cannot cut rates into rising inflation, they cannot hike aggressively into war risk. Another reset. Gold thrives in policy paralysis. Silver amplifies that move. So as Monday approaches, this isn't just about fear. It's about positioning, leverage, and structural pressure building behind a closed gate. And when that gate opens, it won't be subtle. In the next section, we're going to break down 3 specific scenarios from here. Limited strikes, escalation cycles, and full regional war. And what each one could mean for gold and silver prices. 3 paths from here. And what they mean for metals. Let's get specific. There are 3 realistic paths forward based on the scenarios outlined in the source material, not vague guesses. Clear branches. First path, contained conflict. Strikes hit their intended targets. Iran responds symbolically. Both sides step back. No sustained disruption to the Strait of Hormuz. Oil stabilizes. Volatility cools. In that outcome, the document suggests gold could settle between 5,200 and 5,500, with silver holding above 100 internationally. Even in the calm version, prices remain historically elevated. Pause there. The floor in this scenario is higher than the ceiling was months ago. Reset. Second path, escalation cycle. Iran retaliates with force. Israel responds harder. The US becomes more deeply involved. Insurance costs on tankers surge. Even without a full closure of the strait, perceived gold hits 5494, silver 120 Iran. 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 When the world shifts, preparation gets tested. This is the moment where emotion and strategy collide. If you already hold gold or silver, you're probably feeling two things at once: relief that your hedge is working, and unease about why it's working. That tension is human. Let's reset. Nobody accumulates metals hoping for conflict. People do it because they recognize fragility, expanding deficits, persistent inflation, geopolitical strain. The events described in the source material are not the goal. They are the stress test. And right now, the stress test is underway. Gold at 54.94 in tokenized markets. Silver buybacks above 120 in Shenzhen. A $27 spread over the last international spot near 93 markets, closed for 34 hours while risk compounds. That's confirmation of volatility, not a victory lap. Another reset. Central banks have been accumulating gold at record pace for 2 straight years, as described in the TXT. They were buying during trade disputes, during inflation spikes, during relative calm. The obvious question now is, what happens to that pace when missiles are actively flying in the Middle East? Institutional demand tends to accelerate during uncertainty. That creates a structural flaw. Pullbacks become shorter, corrections become shallower, but volatility will be intense. There will be ceasefire rumors that knock silver down $10 in a day, headlines that send gold lower $100 in hours. Then a counterstrike shifts everything back. War-driven markets don't move in straight lines. If you're positioned, discipline matters more than prediction. Now for those still watching from the sidelines. Buying at 5,200 or 93 felt expensive. Buying after a spike feels even harder. That hesitation is natural. But physical buyers in China paying 120 and reportedly refusing to sell are signaling they believe current levels are still below future value. You don't have to agree, but you should understand the signal. Final reset. This isn't about hype. It's about recognizing that paper markets can lag reality. Physical markets often move first, and when both align, repricing can be fast. Monday's open could be historic, or it could be the first chapter in a longer repricing cycle. Either way, the environment has shifted. If you found this breakdown useful, stay connected. The situation is evolving by the hour. Share your expectations for the open. Where does gold print? Where does silver settle? Does escalation continue? Stay alert, stay rational, and most importantly, stay prepared.